So you buy a derivative, IBM buys a derivative that basically sells the risk that they otherwise have
it's an insurance
to exposure
policy.
to the end.
Right.
It's an insurance policy. The end users, and this is the key point, the end users are the people who are saying, I don't want this risk, so I'm going to sell it to somebody. Now, who do they sell it to? They sell it to largely the financial institutions who are willing to buy that risk. That's where our focus should be. Frankly, look, with the end users, do we want to do anything to disincentivize them from laying off risk? No, we do not.
Right.
And if we did that, it would really be counterproductive.
It's just like buying car insurance or home insurance or whatever it is. We want the businesses, whether it's an oil refiner or a power generation company or a computer company, to be able to be in the computer business or the oil business and not have to be in the currency business or the oil trading business. But at the same time, we don't want the banks to exploit that need to sell that insurance to do it in private so that they can, A, mark it up that's more profitable for the banks to sell it in private than it is on an exchange, and B, utilize that leverage to then accumulate more risk. Basically, they insure all the IBMs of the world. They insure all the oil companies of the world, or as they did last fall, insure the mortgage bonds and real estate portfolios of the world, only to find out that they don't have the money to pay the claims when the currency does move on IBM or when the oil does move on Tesoro, and now the taxpayer is paying out the risk, and the bank, whether it's Goldman or AIG or Merrill or whoever, has already collected the premium. And I think that is the core of why people are so fundamentally irate, because they feel like there are financial institutions that are collecting insurance premiums to protect American enterprise from risk, but then when the risk comes in, it's the taxpayer paying out and the banks are the ones keeping the money.
Exactly right, Dylan. If I could offer you a seat on the Financial Services Committee, I would do it right now. You got it exactly right.
I'm just here to harass you.
You know, you got it exactly right. It is the people who are buying risk from the IBMs, from the farmers. We need to keep an eye on, right? Because they are buying risk. They are aggregating risk. And we want to make sure that they don't do it in such a way as to create the kind of damage to themselves that AIGFP created for itself. That's where our interest lies. It's not with the end users.
Hey, Congressman Hines, this
is, you know, everyone's going through a lot of changes. America has gone through a culture change. As I was saying to Dylan during the commercial break, we've got Americans saving money like never before when they didn't save at all before. What's it going to take, as someone who used to work at Goldman for 12 years, what do you think it's going to take to get Wall Street to catch up with the rest of America in terms of changing its culture to this new paradigm that we're in?
Yeah, well, that's sort of the central question of what we're struggling with. And the derivatives bill, as good as it is just one slice of the activities that led to the kind of crisis. So, you know, having been there, I will tell you, you know, there are any number of other things we should look at. And it's not just Wall Street, right? So we did the Consumer Finance Protection Agency last week in the House Financial Services Committee. You know, that is trying to get at the entities, the mortgage brokers, who are out there writing mortgages for people who didn't have income, who didn't have jobs, who didn't have documentation. That obviously needs to end. You know, one of the big topics of conversation is compensation. You know, people are, it's a really ugly political topic. You know, the reality is that compensation, in as much as it incentivized short-term risk, you know, you made your firm $10 million this week and you got paid $1 million of that $10 million. Bad idea, because you just don't know where that $10 million is going to go in the next 2 years and 3 years. So, you know, even though it's a politically heated topic, just to pick one other area here, you know, the government, shareholders of these companies have exactly the same interest in making sure that people within these companies are paid for good long-term value creation and not for taking short-term risk that looks good in the near term but which blows up 6 months down the road.
Dozens, hundreds, angry taxpayers marching in the lobby, dozens in the lobby, specifically at Wells Fargo on Tuesday, demanding that big banks cough up the big bonuses made thanks to taxpayer subsidies. Americans, of course, facing all sorts of foreclosure and other issues. Take a listen.
Say to Wells Fargo and the rest of your big bank friends in the ABA that are waging a war against the working and middle class, shame on you. Shame on you.
Shame on you indeed. The grassroots movement getting even the attention of FDIC Chair Sheila Bair. Remember, those are taxpayer-insured assets that were used as a gambling chip on Wall Street. Again, literally taking your grandmother's bank deposits and using it as a parlor toy to support the casino, a legalized casino. Anyway, we all know the narrative. I want to get into it with George Goehl, Executive Director of the National People's Action, which is the organizer of this set of protests. We have a statement as well from the American Bankers Association, who declined our invitation to join this conversation, but we'll get to their statement in just a second. Again, actually, we'll look at it now. What the heck? Bankers want smart regulation, and the ABA has testified multiple times in the past year in favor of strong regulation reform. They want the government we have to work better filling the gaps in the regulation of non-bank lenders. No one, it seems, again, strengthening safety and soundness, fixing what's broken. We all want that. No one seems to want to actually talk about the fact that a massive insurance scam was run, perhaps legalized, and that money was then paid out by the billion and trillion by the taxpayer, and none of that money has been clawed back. Remember, bank CEO's job is to decide how much risk to take. Paying yourself for risks you can't handle is stealing. Why are the bank CEOs able to keep the bonuses of the past 10 years when they basically stole that money? George, the response that the bankers gave you there, not only to the protests, which I guess that would be, we can speculate the response to that, but to the harsh words both from Senator Durbin and Sheila Bair, who said, I hope to see other measures being taken that will create more resilient, transparent, and better regulated financial system, including an end to the too big to fail doctrine, which is a doctrine by which I sell insurance against things, I keep the insurance money, it's basically stealing, and then the taxpayer bails me out. How do the bankers feel about all this?
Well, the bankers are clearly upset that we showed up at their convention. 1,000 people from 20 states, folks from all walks of life, retirees, family farmers, small business owners, homeowners, or renters came to Chicago because the ABA was having their convention here, and they have led the charge over the last 30 years to deregulate the financial markets. And now, despite all the chaos that many of their members have created, they want to continue to spend money on Capitol Hill like never before to defeat common sense financial reform.
Yeah, I just want to remind folks of what we're up against here. Again, bailouts versus bonuses. Take a look at this. This is the bailout money, the money owed to taxpayers of some of the big banks out there, and then the bonuses that they are going to pay. You're dealing with, again, $225 billion going into B of A, $30 billion in bonuses coming out. AIG, $254 billion. I mean, these numbers are incomprehensible. You take a look at this, and you can see the absurdity of the fact that these bonuses are being paid when you realize it's nothing more than a taxpayer subsidized casino, and even Warren Buffett was smart enough to give the banks money, but to demand onerous terms from the banks for the use of the money. Only Hank Paulson, Tim Geithner, and Ben Bernanke, George, were the ones willing to deliver that money with no strings attached. Ironically, now take a look at this. That taxpayer money is being used by the banks to lobby against the taxpayer as we speak. Bank of America, $1.4 million. Citigroup, $3.1 million. So the money that we gave to the banks is being used by the banks to lobby against the taxpayer. George, do you feel like your message is getting through?
I think so. It was amazing how easy it was to get people to come to Chicago. We had 1,000 folks here the last 2 days, and we expect to have 8,000 people march today in Chicago. And I think really the bonuses, the last round of bonuses, what we see coming up in the future, it was like the final taunt in the face to the American people. We started to feel like bankers and investors were sitting around drinking martinis, actually thinking, are we maybe going to get away with this? It seems like we might. We created the foreclosure crisis. We sent the economy into a tailspin. And then we needed billions in taxpayer bailouts. And now we're going to lobby to kill financial reform. And while we're at it, we'll hand out, hundreds of billions in bonuses. I think people just felt like it's enough is enough. And I think what we're going to see today is really the beginning of a much broader set of mobilizations across the country.
Although I've been thinking about giving up this whole TV thing, George, and going into the banking business, because if you can swing what you just described just by sending a few $1 million to Washington, D.C., and you don't have to even carry any collateral, that's a pretty darn good business. Ryan Grimm with us from the Huffington Post. Ryan, I know you've been spending a lot of your time, along with some of your colleagues at the Huffington Post, looking at the Debtors Revolt, looking at the people that are good customers customers that are either seeing fees attached to credit cards that they don't use, a fee for non-use, or I think the really genius one is when you think about the fact that we are giving the banks all this money, we lend them money at 0%, and then they are jacking interest rates so that they can become more profitable, and I assume use the money to go back to the legalized casino. Where do we stand in the scheme of the Debtors Revolt, and are you seeing more or less of this type of behavior, and if so, where?
Well, you're seeing more of it. And what the Debtors Revolt and what this protest out in Chicago right now shows you is that we really are at a critical time in the history of financial reform over the course of the last couple hundred years. This is something that's been happening in America, every 50 years or so. It goes back to, the 1830s when Andrew Jackson first went after the banks. Then Teddy Roosevelt around 1900 started busting up the trust. Then, 40 years later, you have FDR going after Wall Street. Now here we are, 70 years later, with this new movement against the banks. The American people are pretty comfortable, with wealth and with capital accumulation as long as their own standard of living is increasing and as long as the banks are following some rules. Whenever they start breaking those rules, that's when you see these kinds of uprisings of discontent. Now the question will be, has capital gotten so strong that it's able to fight off the reforms that are the historical pattern? And that's what's going on in Congress right now. That's the question that'll be answered.